February 28th, 2024. We got a big gap down today. Something I noticed is we had a lot of midday reversal attempts this week. Over here, this was a higher low. There was a major trend reversal attempt in here that failed. There was a major trend reversal attempt here, bar 42. So I thought it was reasonable to think we might try to get some sort of midday reversal, which you could argue that we did here. Big gap down and doji bar on bar one. It's not really a very good, buy the close bar. I think, probably sellers above, probably buyers below. When you get a doji on the open, it dramatically increases the chance of a trading range day. Vast majority of the time after you get a doji open, you're going to stay relatively sideways for most of the day. So keep that in mind. Also on the daily chart, this doesn't look primed for any sort of trend day. So I thought it was most likely we were going to go sideways for the majority of the day today. Bad follow through on bar two, which is relatively expected. If you bought above one, you probably were expecting something like two. Follow through for the bulls on three. They're hoping that bears are going to give up and we're going to get back into the moving average, but it's probably not going to happen. I think bears are going to be willing to scale in here. For a bear bar closing near its low, maybe 30-40% chance that three is the high of the day. Logic for that being by bar six, there's a 50% chance you've seen the high or low of the day. So I thought, if you had sold below four, you have maybe a 30% chance of it being the high of the day. Follow through on five, but it's really not all that good. I'm not sure if traders were able to make 5 points. I don't think they were. See, it's actually a trap. So they got trapped out, or they got trapped in, not quite able to make 5 points. You need the market to go 5.5 points past your past the low of four in order for you to make 5 points, since you're going to put a stop one tick below the low of the bar. So that's already 5.25 points. And then the market usually has to go one tick through your limit order in order for you to get filled. So that would be why it has to be 5.5 points. And you can see on bar five, we only went 5.25 points below the low of bar four. So those traders are trapped in. Some of them realize that this might be a trap and they start exiting quickly, and that's causing the bounce on five. Five is a double bottom with one. Bulls want to buy for a swing up. Bears, they want to see more follow through. But, if you sold four, five is not ideal. A lot of traders ended up selling four and they just scalped out because they have like zero true risk. Six, double bottom, micro double bottom with five, and double bottom, essentially one, but not really all that great. The neckline is going to be three, regardless of what double bottom you're using. So I think that you need to wait for a strong breakout above three before you look to buy. More follow through for the bulls on seven, but a disappointing tail on the top. You're still technically on the sell below four, but you really don't want to see the tail on seven if you're long. And you don't want to see, this much of a pullback if you're short. So overall trading range behavior, good bull bar on eight, but a tail on the top. So I'm not really sure that this is going to be ideal. I think that when you get eight, it's a good looking bull bar, but you have to wait for one more bull bar to see what we get, because you want to get a strong breakout above the three high. Sure enough, on nine, it's bad follow through. It's a doji bar. So sellers above the three high. Do you sell nine, the slightly higher high double top? It's not very good, I don't think, since it's a doji bar following a buy climax, which sometimes after a buy climax, double tops form in the second leg is a buy climax. This would probably be a better example of, essentially a big double top, and the second leg was a buy climax. So bad follow through on 10. 11, a bear bar, but again, really not all that great. Probably still always in long. Reversal up for the bulls on 12. Bears see 1, 2, and they're hoping that we end up getting some sort of third push up. I wouldn't buy above 12, but you get good follow through on 13. There were probably more sellers above 12 than buyers, so some traders might end up trapped above 12 once they see 13. Is it okay to buy 13? I think you can buy 13 for a swing, but that traders, bears are going to sell the new high above 9, trying to force a third push up. So they want a wedge 3, 9, I don't know, maybe 14, 15, something like that. So if you're buying above 13, the big problem is that there's probably going to be sellers up here. But you do have a bar closing above the moving average, which is really good for the bulls. 14, follow through, but a big tail on the top, and you can see bears trying to get that wedge to form. Inside bar on 15, potential final flag. The market has memory and it likes to do things, the same things over and over. So we had a couple of inside bar final flags today. This was a potential final flag, tight trading range, potentially here. Final flag 38, final flag 50, final flag 63. So inside bars ended up being a lot of final flags today. Inside bars are just triangles on lower time frames. 14, follow through for the bulls with a tail, and then 15, an inside bar. It's by the close, but I'm not sure how much higher we're going. It's reasonable to be long and just get out below any bear bar. Again, the bears still have the wedge argument. They're trying to form a wedge. And what the bulls want to do is get enough bull closes that they can convince traders that we've broken out of the wedge. So you can see on 16, it's not a good bull close, but it's still a bull close. Now you have 5 straight bull bars. And same thing with 17. It's not a good bull close, but it's another bull close. And the argument for the bears of a wedge is becoming less and less valid. And as it continues to become less and less valid, bears start thinking more and more about giving up. And bears give up, and that's what causes the bull bar in 18. It's still a breakout above a bull channel, so it's not the best probability. But okay to be long, reasonable to be looking for, a move up. But I think this, we're probably not going that much higher. This is a pretty unusually long micro channel, and we're probably not going to get a really strong breakout to the upside. Follow through on 19, but a tail on the top, so not all that great. A lot of traders who bought above 18 will just scalp out with a couple points during 19. And then 20, a bear bar closing near its low. You could argue it's some sort of parabolic wedge, I suppose, but I don't think you're selling below 20. I think you're just exiting. Most likely what you're going to get here is 2 legs sideways to down to the moving average, and that's exactly what we got. So 21, a high one for the bulls, but this is a leg in a trading range. This doesn't really look all that much like a strong bull trend. 22, bad follow through for the bulls above 21. This might be a broad bull channel. It's possible. Thought that was the argument for the bulls, over here, which this was a bull channel. We were going to strong breakout to the upside. 23, double top, 20, lower high, but probably just going to be some sort of second leg and then, scalping out, bad follow through. So probably more buyers below, scaling in lower. 24, kind of disappointing for those bears who took the sell. And then 25, outside down, but, if you take a look at it, it's really not all that great. If you think about it, it's really just the second leg down. It's 1 pullback 2, so it's 2 legs down from that. And bulls might try to get a new high. Bull bar 26, but not quite closing on its high. And then bull bar 27 closing near its high, but big tail on 27, a lot of overlap with 26. Bulls were more interested in buying the correction of 26, the 50% pullback, than they were buying above it. So 27, a good bull bar. It's still always in long. I don't really think we really went always in short in that correction. So it's still always in long 27 and okay to be long. But the problem with buying above 27 is the overlap 26 with the prior bar, the overlap in general with the past 5-6 bars, and you're not even breaking out above the 23 high, which is an important breakout point. Additionally, there's going to be sellers when we touch this price because the bull's about to close at 19 and they haven't been let out yet. So, anytime any sort of bounce is probably going to be sold. And you get disappointing follow through 28. And inside bar 29, I know bulls are going to exit below 29 and bears sell. I think it's probably an okay swing sell on the premise that this is a trading range day. And if it's trading range day, gaps should close. So we should theoretically get back to, all the way back to the 12 high because there's an open gap. And the bears who sold above 12 did a reasonable thing and they should get out around break even with profits on their scalings. So you can sell below 29 basically on the premise that today is probably a trading range day. But it can be a little hard to do that against this tight of a bull channel. But, tight channels are less relevant in trading ranges, I think, because you can get quick bounces up and down. 30 follow through, but it's really not all that great. We did get a deep pullback. And then 31 found buyers at the moving average again. Bulls want it to be a high 2 and they want some sort of swing up here, but instead disappointing follow through inside bar 32. Inside bar again 33, so it's an II pattern. Do you sell below 33? I suppose it's a credible sell. You're towards the top of a trading range and it's an II, so an II at the top of a trading range is going to be a credible sell. Follow through for the bears on 34, so II and then follow through. The bulls are hoping it's 3 pushes down. This was their attempt up and then 1 pullback, 2 pullback, 3. We didn't break out below the low of 25, which is disappointing for the bears. Then you get a disappointing pullback on 35. But then another bear bar 36, but a big tail on the bottom. Bigger bear bar 37, it's getting parabolic, but a big tail on the bottom. And then 38, an inside bar, low 1 short, but it's a low 1 short at the bottom of a trading range. It's really not as good as it could be. I think most likely here we're going to end up going sideways. And that's why you get outside up 39. There's obviously a chance that we ended up just getting a collapse below 38. And it is, in theory, a reasonable sell to close bar. But, you're always in short for sure. But usually in trading ranges, right as the market becomes clearly always in short, you get a reversal. And right as the market becomes clearly always in long, you get a reversal. So really not all that great. But 39 a bull bar, but this is really tight, and you're kind of buying towards the middle of the trading range. You probably want to be buying a bit lower. So if you're buying above 39, you're buying towards the middle. So really not all that great, and that's why you get disappointing follow through 40 tail, and more disappointment 41, an inside bar 42, but you don't want to sell. Follow through for the bears on 43. We were probably always in short for most of this, but I don't think the follow through is going to be that good. You can see on 44 as we tested the 38 close, traders bought back shorts, and that's partially what contributed to this and this bounce on 45. 45 is a surprisingly strong bar. You might have trap bears above 44. Bulls want to break out above, the double bottom from 39 to 45, neckline 41, and measure move up somewhere up there. They'll also scalp with 5 points since it's a trading range. I'm curious to see if the bears who sold below here, yeah, they got their 5 points at least. So a lot of traders, taking trades today looking to scalp with 5 points. You can see earlier in the day, traders got trapped out of a trade, just like I mentioned, selling below 4 just before they made 5 points. So, that's going to be a relevant profit target. Follow through for the bulls on 46, but a tail on the top, probably a reasonable buy the close bar, and follow through on 47, but again, a tail on the top, and you're getting towards the top of the trading range. More follow through for the bulls on 48, but again, it's reasonable by the close, and it's a tight bull channel, but you're towards the top of the trading range. Same kind of problems with 49. It was okay to be long for any of this. You're just going to get out below a bear bar. You get an inside bar 50, doji bar, trading range bar, top of the trading range, final flag, and then outside down 51. Traders are going to exit below 51. Bad follow through 52. I'm expecting at least 2 legs sideways to down here. After this, it's a double top, or you could argue it's a triple top, 20, 28, 51. So I'm expecting at least 2 legs sideways to down. Bad follow through 52, but 53, not the best high one entry bar at the top of the trading range for the bulls. Really not what you want. Sorry, I had to get a sip of water. Really not what you want, especially considering that we've only had 1 leg down, 51, 52, and we probably need a second leg down. So some follow through on 54, but a micro gap down. Traders are exiting. You can see we got back to the 50 close. The bulls who bought the close at 50, hoping for a pop, disappointed 51, 52, or flattening during 55. 55, double top, bear flag. I don't know, maybe 40, 50% chance that we get some sort of measure move down to here. And good follow through for the bears on 56. And what are the bears who sell 56 to? They scalp with 5 points. They were able to make slightly over 5 points during, 58, and they made exactly 5 points during 57. So if you sold below 56, you were given 5 points at the low of 57. And a lot of traders see that they were able to make 5 points, and they just take that, especially when it's that quick within 5 minutes. And now we're at the bottom of a buy climax, 45 to 50. So I thought it made a lot of sense to take profits there. And, and that tail on 57, that's what's causing the big bounce on 58, right? Always in days are opposite days, essentially. The problem with trading range days are opposite days. The problem with trading range days is they always look like they're going to become trend days. And trend days always look like they're going to become trading range days. So it kind of makes you want to trade it the incorrect way. And that's why trading is so difficult. Or one of the reasons. 59, bad follow through for the bulls who bought up at 58. 58 is not a very good buy. You want a second leg up from 45 to 49, but the big bear spike was pretty strong. You need its own second leg. 60, a bear bar closing near its low. It was probably a reasonable sell for always in short bears. This bar was stronger than traders thought it was going to be, so bulls who bought below 59 might be trapped. But the follow through on 61 is kind of lackadaisical. If you sold below 60, you wanted to see a big collapse essentially, and you didn't get it. And you can see right here, bears who sold below 60 able to make 5 points during 65. So you sell 60, you get follow through 61, but not all that great. And then disappointment 62 and a potential final flag 63. Bears selling above 63 during 64. And now they know they're going to get a second leg down. And the second leg down just ends up being to where traders scalp out with 5 points. Usually, 82% chance we break out of the 18 or the 36 bar range every day. Today was one of those days where we broke out of the 18 bar range, but not the 36 bar range. You can buy above 65, I think, probably a reasonable 5 point scalp, I would imagine. And you can see follow through 66, and then some traders scalp out 67. Any trader who didn't scalp out had about 5 points during a little less or on the close of 67. And but it's it's a theoretical buy the close bar, but you're in the middle of a trading range. So really not all that great to be doing anything. Traders are more looking to exit here, and that's what causes 68. Doji bar 69, universal up 70. And you can see we just got back up to the buy the close, and essentially probably a final flag 73. And then we just went sideways the rest of the day. For stop orders, probably 13 is okay. You could probably sell 20, 29, 33, probably okay. Probably 34. I guess theoretically 39, but it's probably not as good. Low in a trading range. 45 is good. 50, 56 is good. 60 is probably fine. And then, yeah, that's it. On the daily chart, inside bar, low probability that we just get a collapse tomorrow and go straight down to the moving average. I think most likely we'll get some sort of, was it even a bear close today? Small bear close today. So most likely I think we'll trade a little bit below yesterday's low and that low, and we'll end up getting probably bad follow through. So probably going to look for some sort of reversal up below yesterday's level tomorrow. And yeah, that's the day.